David, just wanted to make a brief, small correction here on CP.
Yeah, I apologize. I got ahead of myself, and of course I switched up CN and CP. Of course, CN has more north-south traffic. CP is more east-west. I still like CP. We do own the stock, but CN has more north-south traffic.
Back to phone calls. We have Rita in Waterloo. Hi, Rita.
Hi. I'd like his opinion on a company called Toromont.
Okay.
Okay.
So Toromont Industries is in the equipment, heavy equipment. The stock has done quite well. We're a little bit cautious on heavy equipment in general. So while the stock's doing quite well, we're tending to focus more on consumer and healthcare and technology, less on equipment.
So why has Toromont been doing well when Caterpillar generally has not been? Because it does distribute Caterpillar products.
Right. Well, they also are focused in the construction market, and construction's done quite well. But the heavy equipment like Caterpillar is more international, and of course the strong dollar's made it more difficult for them.
So you're steering clear of those types, some of the Joy Globals
Yes,
and
we are.
those kinds of companies. Thank you, Rita. Peter's next in Oakville. Hi, Peter.
Hi, thanks for taking my call.
Sure.
I'm a senior depending on income, and I'm holding currently, among other things, Crescent that have paid me a very good dividend. And I'm not interested in the short term, but in the long term. I have seen them from $20 to $50. Now, I understand that Vermilion does much of the business in Europe where they get a higher price. So would you recommend switching from Crescent to Vermilion, even though Vermilion only pays half the dividend? So if Crescent would cut their dividend by 50%, I still wouldn't be ahead. So what's your opinion? I would appreciate your comment.
Thanks, Peter.
So, Peter, I want to go back to comments I made earlier where basically the point I wanted to make is that 80% of the return that you get from your investments comes from getting to the asset class that matters, in this case equities, and then second, finding the themes that have a win from whatever the macro backdrop is. And I would argue that you don't have the thematic backdrop that is good for energy. And so while Vermilion, I think, is a good company, and you're right, they do have some European exposure, which is a positive, it is going to get painted with the same brush that all energies are going to get painted with. So I don't think you should be switching horses from one energy stock to another. I think you should leave energy and move on to a different sector. I think both are going to have difficulty if energy prices go lower. I think there's some real risk to natural gas and to oil prices headed into the summer. If you really want to buy energy, maybe you wait a little longer to see how it goes. Because if the price of oil and gas stays low, none of these dividends are safe. So don't get caught up in a high yield in Crescent Point or a high yield in Vermilion. I think that there's risk. And so I would look at a different sector.
There you go, Peter. Thanks for the call. Mark is next in Markham, Ontario. Hi, Mark.
Hi, how are you?
Good.
Good. Just Suncor, I know you're a bit of an anti-energy guy here, but if you look at the 10-year price of oil, it's, it's gone from 40 to 140. It just seems to me to be a good long-term play, and entry into Suncor at this price with the dividend that seems sustainable seems like a good investment. I'd like your opinion on that.
Right.
All right, thanks, Mark. So you wouldn't describe yourself as anti-energy.
No,
you're more pragmatic.
We aren't anti-anything. In fact, our mandates have no constraints. We can go to any sector or we can void any sector. And this is a sector I'd like to void. I think that there is risk in the dividends in virtually all of these companies. We are looking backwards here, Mark, and you have to look forwards. The dynamics, I believe, have changed, and the oil sands producers are relatively higher cost producers. And if prices were to stay down here for some time, it's going to be tough. So in the near term, you have challenges. I think longer term, you have some challenges. It's not to say that this sector can't get turned around, but I think that it's not likely given the macro backdrop that we have today. So I would encourage you to consider looking at a different sector. If I go backwards, in 2003, the question we got on this show all the time was, is it time to buy Microsoft and Cisco? And at that time, my view was it's agriculture and commodities. So that's 12 years ago. We've had a whole commodity cycle since then, and we are back into, I believe, a paper asset cycle, and you want to be looking at companies that benefit in that world, and I don't think that the energy companies fit that bill.
Is it safe to say that the one thing you hate as a money manager is, or dislike or loathe, is dead money?
If you're in a bull market, take advantage of it, right? because I'll tell you, the easiest thing to sell to an investor is what worked yesterday. And we've gone through the biggest boom in oil production in North America in the last 50 years, in the last 5. And a lot got priced into the market. And I'm not saying that there aren't individual companies that will do well, but the job, I think, as an investor is to maximize the return you can get on your capital by finding your way into sectors that other people are willing to pay higher prices for due to something changing for the better. Right now, there's nothing changing for the better in energy. In fact, there's probably some real challenges.
All right, David, another break, a handful of questions after this, and then after that, we'll get to top picks. Stay tuned for that.